So on to the Money Show. Let's get started with our first discussion, and that is on the various available schemes for investment for all the senior citizens. And upon retirement, senior citizens need to plan their finances carefully so that the corpus they have created is able to provide them financial security in their retirement years as they have specific needs and goals. And on the Money Show today, we will help you plan your post-retirement life. We have on board Mr. Hemant Sood, who is the promoter and MD of Findoc, to discuss the various investment options from Senior Citizen FDs, Senior Citizen Savings Schemes, PM Vaya Vandana Yojana, among others, that you can consider to secure your post-retirement life. Hi, a very good evening, Hemant, and thank you so much for all your time to ET Now. Firstly, let me start with the various kind of schemes that you have got for our viewers. There are a lot many schemes that we wish to be discussing on, but as a starting point, as these senior citizen schemes do offer not just the security benefit, along with that, the risk is lesser in compared to the other asset classes that we have. And with respect to that, there's always a buffer of maybe 50 to 100 basis points that all these senior citizen schemes are offered. But just to start with, amongst the list of schemes that we're going to be discussing, what is the range of investment, or rather the range of return that a senior citizen scheme while investing should be expecting?
I think the senior, thank you, Srishti, first of all, for inviting. I think for the range, it depends from person to person and what that person feels that their contingency fund should be. So that there cannot be a fixed range. But anything which you think you need in a contingency, which you think need for a critical illness, or you need for a particular thing in a family, so that is the minimum you should have investments in the senior citizen scheme. And as you rightly said, that most of the senior citizen scheme has a buffer of 50 to 100 basis points for the senior citizens. And nowadays, these days, people like to invest on the name of the senior citizens, like son like to invest in the name of the father for particular this buffer point.
We'll touch upon that, but this was just to set a context that in terms of if anybody is looking forward to invest in the senior citizen scheme, what kind of a broad range of return they should be expecting. But nevertheless, we'll try to get the perspective, or rather discuss in details all the schemes that are available that not just offer you a little bit of less risk in terms of other asset classes, maybe like equities, but other than that, what kind of a return expectation and what are the pros and cons. So let's get started. And Hemant, the first scheme that we wish to discuss is the Pradhan Mantri Vaya Vandana Yojana. How do you see this, and what kind of benefits senior citizens can have from this particular scheme? Take it away.
I think this is an excellent scheme by the government of India. It is for the 6 year and above, and these are not open for NRAs, but this is open for only Indian citizens. And this the rate of interest normally ranges between 8 to 8.3, which is higher than the normal FDs in the bank. This scheme also has a tax benefit, a little bit of tax benefit as well. And but for withdrawal, you need a critical illness. When you can't withdraw otherwise, 98% of the amount you can withdraw in a case of the critical illness. And maximum you can invest in this scheme is 15 lakh, and the minimum is 1.5 lakh.
Okay, so those are the points that are promising interest rates of 7.4 to 8%.
This is for 10 years. This is for 10 years.
This is for 10 years. Okay. Yeah. So if you stay invested for 10 years, then at least 7.4 to 8% is what you should be expecting.
8 to 8.3, 8 to 8.3, which is higher than most of the schemes.
Okay, so under 15 lakhs is if a senior is going ahead and stay invested for 10 years, then you are saying that this scheme can give you 8 to 8.3%.
And the rate of interest changes after every time the government announces the new rate whenever. So right now the range is 8 to 8.3.
Was a tax benefit, Hemant, right?
Yeah, this is a little bit of there's no tax deduction benefit under Section 80C, but this exempt from the being taxed on the investment amount, but the interest income is taxable in this scheme as per your income tax slab.
Okay, so that's all about Pradhan Mantri Vaya Vandana Yojana. But Hemant, this is one scheme that is offered by the government. But not just the seniors, but a lot of viewers don't actually look at the debt instruments that are available for investments. In the list that we have curated for our viewers, that is NCD as well. It includes NCDs as well. So for senior citizens, how do you see this particular instrument and what kind of a benefits that they can have? And other than that, what options are available where they can actually go and invest their money in?
So I think for the NCD, I will not advise senior citizens to invest in NCDs. But obviously, there are some NCDs where you can invest. But I don't recommend senior citizens to invest their contingency fund in the NCDs. NCDs in nature has a little bit higher risk than the FDs and the post office scheme, senior citizen savings schemes, Pradhan Mantri Vaya Vandana Yojana. So that has a little bit higher element of risk, and obviously there's a little bit higher return as well. Most of the NCD, the private NCDs goes between the range of 10 to 11%. And but if they are looking for a better return, and then I recommend they should invest in the probably the government backed NCDs or AAA rated NCDs, which are a little bit safer in context.
Okay, so there you go. That's all about NCDs. And Hemant, the options that are available, that is India Grid Trust, that is providing around 7.8%. And other than that, NIIF, National Investment and Infrastructure Fund, that's also an option available, right?
Yeah. That's also an option available, and these are partially backed by government. So I mean the security perspective is okay here. So, but normally there are options available for the right now for the citizens to take a interest rate of 8+. But if any senior citizen is in a higher tax bracket, and these are the bonds are a good way to invest, because they provide tax incentives as well, because you have to pay short term or long term capital gain if you redeem after 1 year, and which is mostly the case in these NCDs. And so if you are in a higher tax bracket, then you can also consider NCDs.
So this particular scheme, what Hemant is highlighting, that if you are in the higher tax bracket, then those senior citizens can actually opt for this. The two schemes that Hemant highlighted is India Grid Trust, that could offer 7.8% yield per year, as well as NIIF, that is providing around 7% of return. To 7 to 8% is the range that is coming in for NCDs and for all those who actually come in the higher tax bracket. But Hemant, let's move on, and I'm sure that most of the senior citizens must be having this particular investment, and that's like amongst the majority of them we see this, and that is FDs. So how do you see this? Because as per my experience, a lot of senior citizens do find this the safest of all, and they just go in the bank and invest their money. But what is interesting to note is not just the banks offer the FDs. There are other NBFCs that do offer FDs, and even at a higher interest, what you can actually benefit from. So what's your understanding? What's your opinion on the same? How much amount of money, or rather a portion of money, they should be investing in FDs, and what kind of a return expectation they should be having?
So again, these FDs are one notch, probably depending on what kind of FDs you are proposing, but they are notch lower than the regular FDs in the bank. But obviously, they provide better rate of interest, and so if you really want to go, if the interest rate is the only criterion, if you want to go these FDs, I will recommend there are like big institutions which provide this as FDs, mostly AA, AAA rated FDs and bonds. So I think the senior citizen should consider only with a higher rating paper of these FDs of this NBFCs. Because for me, I think for the safety of the fund, and much importantly, the timing of the excess of fund is very, very important for the senior citizens. So I would say that if you are going outside the banking regime, look for a paper, look for FDs which are highly rated by the rating agencies.
One should definitely
You
look
may
at.
get may get half an or 1% less than the normal FDs, but I would suggest that's worth it.
Okay, so one should definitely go for those higher rated FDs. But Hemant, among the differential between what banks offer and what the other NBFCs offer in terms of the rate of return that you get on FDs, anything you wish to highlight there, and any particular name amongst all the names that are available you wish to highlight where viewers can consider investing their money?
I think there are a lot of FDs available with now the merger has happened, but earlier it was available for the HDFC as well. I think there are a lot of tier one NBFCs where you can have a you can invest in these FDs. Before the HDFC merger, HDFC FD was very good. I think there are a lot of bond providing sites, and there is a lot of comparison available in the like even in the ET Money, where you can compare most of the what are the AAA bonds in India, and you can invest in those bonds. And as a matter, I would suggest that you, as a senior citizen, you should have invest some money in the regular bank FDs and some money in the bonds, so that will average your the return as well, and it will give you a little bit of easier access and little bit more safer. And just mind it, the most of the FDs of the this NBFC are fixed tenor FDs. So probably you can take a loan on there, but you can't in cash before the fixed tenor. So there's one catch in it. Obviously, you can take a loan on it, but most of the FDs are this NBFCs are fixed tenor FDs. So if you need access to that capital before that due date, the option is you can take loan on those FDs. But the prior encashment is in some of the FDs are restricted.
Encashment is a bit restricted is what Hemant is highlighting, but definitely if you're in need of money you can actually take some loan.
And to the name, sorry, I missed out the name. So PNB Housing Finance FDs and earlier there used to be HDFC, and you can consider these FDs.
Okay, PNB Housing Finance is what you're highlighting, Hemant, and any return expectation amongst these FDs? Because what I understand is the maximum is 9.5%. So what's your range that you wish to?
I think it depends when you're depending on the current interest rate cycle. But I think if the bank interest rate is X, so you should consider these FDs at least 150 BPS higher than the bank interest. So if the bank interest is 6, you should consider 7.5. Right now, the bank interest is between 7.5 to 8. So you rightly said you should consider around 9.5, 20 bips here and there. So you should consider this FDs around 9.5. So mostly these FD pricing, some of the bonds are actively traded in the market. Their prices fluctuate with the interest rate fluctuations.
Okay. Hemant, let's talk about the Senior Citizen Savings Scheme. This has been quite a successful scheme because it was launched back in 2004, and since over the years, it not just give you some tax benefit, it has some minimum as well as the maximum capping as well, and we have seen a lot of investors or the rather senior citizens getting interested in this particular scheme. Apart from all the schemes that we have discussed till now, why do you see that small savings scheme is one that is standing out, and what's your opinion on the same? Should a senior citizen actually consider amongst all the options available, and what are the pros and the cons of the same that you wish to highlight?
I think senior citizen scheme also offer a tax benefit like ATC. So you can engage, that allows you a tax deduction of the investments. And so senior citizen scheme is a good scheme if you're in a tax bracket where there's outgo of a tax. So it helps you to reduce your tax liability. And again, if the maximum investment is around 15 lakhs, you can't invest more than that. And there's a premature withdrawal also. I think something around 1.5% if I'm not wrong. Before 2 years, and after 2 years, I think there is a 1% is a premature withdrawal also. But the rate of interest is backed by the government of India, so super safe. Rate of interest, I think it's around 7.5, something like that.
Okay, 7.5 is what you are highlighting for small savings schemes, Hemant?
So sorry, 7.4 is I think rate of interest for these FDs.
Okay, so small saving schemes is a couple of points and important points being highlighted that you can actually take a pre-maturity withdrawal as well. This facility is available. There could be a cut of around 1 to 1.5% in your overall return and or the interest amount rather. So that is one thing. The other benefit that you're going to be getting is the tax benefit. Other than that, there is a limit of 1,000 of minimum investments, and what Hemant is highlighting is 15 lakhs is the upper cap. But moving on, Hemant, the last scheme that we wish to discuss is the post office investment. And not just in the urban areas, in the rural areas specifically, this scheme has a lot of attraction amongst the viewers. So amongst FDs and post office, if you can just help our viewers understand what exactly is the difference and where the differentiating factor lies, and amongst the two, because both of these are some instruments that are backed by the interest rate set by the government. So amongst them, which one would you prefer?
I think it depends. The earlier the post office monthly scheme was popular because if you go back a few years back with when the interest rate cycle was lower, the post office schemes used to provide a higher rate of interest, like more than 150 bps higher than the normal bank rate of interest, and so that was at that point it was very popular. Right now, I believe that there's no much interest differential available in the post office schemes. But the interesting point in post office scheme, there's no TDS on it. So no tax is deducted on the monthly interest on the post office scheme. I know it may matter nothing to some people, but still, if you have no extra ability, you won't want the tax to be deducted and you claim from the by filing your return. And mostly, this doesn't have a tax benefit, not eligible for tax benefit under Section 80C post office scheme. Like the investment, it's not available for tax benefit. In my personal opinion, the post office monthly scheme is no longer attractive, but obviously it's backed by Government of India. You can get the rate of interest from the post office when your monthly income and rate of interest from the post office or from your dedicated bank. But there's a premature withdrawal also, 2% penalty also if you withdraw between 3 to 5 years. I think before 3 years it's 2%, and between 3 to 5 years it is 1% penalty, and normally the maturity is after 5 years.
Okay, thank you so much for highlighting the difference between FDs and post office, Hemant. With this, we'll let you go on that, and thank you so much for all your time to ET Now.
Thank you, Shishi. Thank you for inviting me, having me over. Thank you, and you're doing a great service to the senior citizens. For enlightening them.
Well, yes, we hope that a lot of senior citizens are benefit watching this special edition or this programming, wherein we did highlight a lot of investment options available that are not just offering you a lesser risk, but other than that, there are other benefits with respect to the tax benefits as well as tax deductions. Other than that, what kind of return expectation you must be having is what we highlighted in this particular segment. But with this, viewers, it's time to slip into a short break, but don't go anywhere. We'll be right back with more. Welcome back to the Money Show, and moving on, let's shift focus to the equity markets, which have been volatile this particular year. While markets have inched towards their newer highs in the recent days, markets have also seen extreme volatility earlier this year. And so how do market falls affect the fund flows, and what are the factors that drive fund inflows? Let's welcome on board Mr. Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management, and he will also answer these questions. Not just that, we'll also have some understanding that how to read the various market data as well. A very good evening, Feroz, and thank you so much for joining us today on ET Now.
Hi, Shrishti. Good evening. Thanks to have me on your show.
Okay, so a very interesting topic that we have got for our viewers today. And Feroz, just reading to the data, back in 2022, Nifty gave almost a flattish sort of a return was up in single digits. But the major factor was that the FPIs were pulling their money out of India. It was almost 1.2 lakh crores of outflow that FPIs have done, but thanks to the DIIs that did support the market movement. But if we see 2023 coming, the first half, or rather the first 2 to 3 months, they were depressing. The FPIs were still pulling out. But what a recovery, or what a comeback that they have made. 94,000 crores worth of pump in terms of investment is what they're seeing. And look at the move in Nifty 50, almost near to its life high level. So how should one read this data? Is it that so that whenever FPIs or FIIs will make a comeback in the Indian markets, then only we will see the market moving upwards, or when they are pulling out, the markets could give a depressed sort of a return? What's your understanding, and what does the history tells?
Srishti, I'll answer this in parts. There are quite a few things which a person can infer from the piece of information which you just articulated. Firstly, I think what has happened over the last decade is a structural change of Atmanirbhar capital markets. Let me substantiate with the point. Like last year, FIs took away 1.2 lakh crores. That's a lot of money, right? That's more than 12, 13, 15 billion dollars going out, and the market being marginally positive. That implies that 10 years back, if the same thing would have happened, markets would have closed that year with a minus 20% tick. But why did it end 1% higher in the financial year in question? That's because SEBI tried to make one change. Structurally, two large changes were made. One of which was done in 2013, and the other one was done in 2018. SEBI in 2013 started educating Indian investors to get a reasonable pie of the domestic Indian household saving. The Indian household saving as we speak is 670 lakh crore, okay, which only 21 lakh crores is equity mutual fund. Look at the power of the Indian household, 670 lakh crore. So when SEBI started educating the Indian investor by starting an education initiative using mutual fund as a platform and AMFI as a platform, that has changed the mindset of the Indian household from seeing a mutual fund as a risky instrument to the logical, most safest product platform from a transparency standpoint. That's one thing which has made sure last year you don't fall. Second thing which SEBI did in 2018 was simplifying the life of the investor. And that's why you see 14,700 crores in a single month coming from the Indian lower strata. That's 2022 for you. And this data, why is it very important? Is because this will tell you over the next 10 years, how buoyant will our markets be? That's point one. Point two is the domestic flows have been robust, and they will become far more robust. And I have already predicted it on your show that in the next 3 years, you will see 25,000 crores every month coming in the form of SIP. I'd said this when the SIP numbers were 8,000 crores, and I reiterate that you will surely by FY27 reach 27,000 crores of monthly inflows from Indian domestic households. So it will be a very buoyant market. Then coming to the volatility point, you would be very happy to note and have immense pride as an investor and an Indian that the volatility, if it's numerically measured in the form of standard deviation, has been lower than the US markets, which is 100 years more older. That's because of the domestic flows. So the risk levels of India has come down significantly, because if you measure it in standard deviation, which is how volatility is measured, like return is measured in compounded returns, risk is measured in standard deviation most popularly, and we have produced lower risk than the US market over the last 1 year. And coming to 23, I personally think the FIIs will return. I was just there in Paris on a global event last weekend. This weekend, I would like to say. And I've met about 400-500 global investors, and their take on India has dramatically changed over the last couple of years.
Rose, you seem to be echoing the positive view on the Indian markets, definitely. But before we go ahead and talk about the other touch points like SIPs and the fund inflows, just wanted to ask you, when are you expecting Nifty to touch their all-time high levels? Because it has been a touch and go movement for the past 1 month. There has been a lot many instances. So we are just a century or maybe 200, 300 points away from the all-time high levels. But what's your expectation? When can we see that happening?
See, Srishti, to be honest, that will require some crystal ball gazing, which I don't have. But I personally think, of course, as a sentiment standpoint, as a happiness standpoint, a peak makes a difference. But if you look at a 1 year, 2 year, 3 year kind of time frame, getting more than the double-digit returns on Nifty is upwards of 90% probability. Of course, there's 10% probability of things going southwards, which is always going to be the case. But if you ask me pointed, I think this year a peak should be established. It should be around the corner, but because just 0.5% away from the peak, which is about 18,858, if I'm not wrong. We're just hovering there and we have not touched that so far. So I think this year is going to be good. Last year wasn't good. So the probability of the future becomes better if the last 4-5 years have not been stupendous returns. Of course, after COVID, the correction, the market has moved up. Now coming to very pointed inflation, which is the global concern, doesn't exist for India because the inflation numbers which we produce are lower than the last 10 years average of inflation. The US has produced inflation numbers which are 400% more than the average of the last 10 years. So whatever is the globe's problem is business as usual for us, is why we are a brighter spot and attracting global inflows. And I think it's just scratching the surface currently.
Okay, thank you for that take, Feroz. But moving on, getting back to the SIP inflows that you were touching about, you are expecting that 25,000 crores is what you are expecting from the inflows, and now the data stands at 14,749. So that's an exponential, or rather a significant jump in the next 3 years, what you're expecting. But given the whole scenario and the setup that we have discussed, how the Indian markets are placed, which particular type of fund, be it large cap, mid cap or small cap, is expected to outperform? Because given the fact that FPIs have made a comeback in the Indian markets, especially since the March lows, the broader market space is definitely buzzing. So if one has to take a view going ahead that now that the FPIs are once again back and the outlook is also positive, then which particular type of fund they should be eyeing at for rather to create that alpha around?
Shishi, this is an easier question to mathematically answer than the previous one. So let me give you some mathematics. First, I'll tell you the headline. I would prefer having at least 30% in the small cap space for the next 1 year, at least 30%. On an overall implied basis. See, what happens is when you buy 10 funds, each of them might have some degree of small cap, some degree of mid cap. When you open all these 10 boxes and see the implied exposure, 30% could be in small caps, 20% in mid cap, and 50% in large cap. Mid cap being smaller than small cap is a huge message that from a relative valuation standpoint, the 150 stocks which are called mid cap stocks are a little overvalued. Hence, we think that the large cap is attractive, the small cap is attractive. The least attractive of all these three segments is those 150 stocks, which are called mid cap as per SEBI's definition from a mutual fund investor standpoint. That's point one. Point two, why do we believe small cap will do well? Is because the rear view mirror has a very shoddy picture. Last 5 years, small cap has underperformed Nifty by 4% every year. Every time this has happened, that small cap has underperformed for 5 big years, the next 3 years have always been good for the small cap period. Since the rear view mirror is showing a very ugly picture for small cap, the probability of small cap outperforming the Nifty goes up significantly. And if history has to be believed, there is 95% chance that small cap will outperform Nifty over a 3-year holding period from now on. So at least for 1 year, you should have 30%. If small cap does very, very well over the next 1 year, if it so does, fingers crossed, then you may want to lighten your small cap exposure. But this question needs to be re-answered a year from now.
Okay, thank you so much for highlighting that data, how the small cap, when in instances it has underperformed, then one can expect the outperformance in the times ahead and how you should definitely place yourself out here. But if we talk about the return over the past 22 years, what you have shared is that Nifty in the past 22 years has given at least 12.5% of return on a per year basis. So going ahead, Feroz, do you expect this particular number to be stretched even more, given the fact that the FPIs, or like you were highlighting as well, that the FPIs are very much positive on the Indian markets, and we are seeing the retail participation coming in a big way. So what's your understanding for the markets, and what kind of an expectation in terms of the EPS for Nifty 50 is what you guys are factoring for?
Yes, so there are a lot of questions in this, Trishti. I'll try and answer, and I will try not to miss all these important ones which you asked.
Okay.
When you look at bullishness from FPIs and domestic inflows, an investor should look at this money as a risk mitigant, not as a return spinner. If you have marginally bullish FPIs and good domestic flows, then the drawdowns in the market are not going to be as steep. Like, what should an investor worry about is the COVID-like kind of situation where the markets fall like a knife. Markets every year fall from peak to trough almost 19% every year. So markets are going to fall. That's the nature of the beast. An investor needs to be mentally prepared for at least a 10-15% drawdown every year from peak to trough, because 22 years history says market will find its reason to correct. But the problem happens when a 2008 or a 2020 happens. Then an investor becomes very difficult for an investor like you and me, Shrishti, to be in the game, to look at the light at the end of the tunnel. So point one, because of this bullishness of FPI and domestic flows, markets are going to be buoyant, and sharp falls like GFC and the COVID are very, very unlikely. That's point one. Point two, coming to the EPS earnings. We were one of the very few wealth management outfits which predicted an earnings growth of 30% when Nifty's earnings moved from 535 to 772. And then last year, it closed at 840. If you remove the one-time expense of Axis Bank when they bought the Citi business. 840 was the earnings last year. We predict this financial year to be 936 earnings. So if you look at all these 3 years put together, which is how an investor should look at, 535 to 936, that's one of the sharpest earnings growth in the globe. And that's why markets have not supported a bear and supported the bulls, because the corporates are doing well, and 936 is our earnings estimate for this year for those 50 companies. And that makes markets in a reasonable range of valuation.
Okay, markets looking in a reasonable range of valuation. Thank you so much, Feroz, for highlighting and helping with whole of the study that how the FPI's inflows have impacted the Indian markets in the past, and going ahead, what is the outlook on not just the inflows, but with respect to the performance of the broader end of the market as well as the large caps. With this, viewers, it's time to slip into a short break, but hang on, Feroz. We'll be right back, and then we'll be taking all the portfolio-related queries of you viewers with our expert, that is Mr. Feroz Aziz, but just after this quick break, so stay tuned. Welcome back to the Money Show, and it's time to take all your portfolio-related queries onto the show, viewers, because we understand that there are plethora of funds that are available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that you should be looking at? And to help you navigate through this maze, we have on board Mr. Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management. And also, do not forget to send us your portfolio queries on a WhatsApp number, that is 865-797-4571. And you can also email us your queries on the Money Show @etnow.tv. But let's get started with the first query, Feroz. And the first query is a caller. And onto the phone line, we have Advocate Walson from Kerala. Hi, very good evening. Please take it away and share your query. We have Feroz on board.
Yeah. Very good evening, madam. How are you? Okay. I have sent some WhatsApp messages regarding my SIPs. I have a few SIPs whether to continue or not. That's what my query. Yeah, this is regarding one. My WhatsApp message is there already, no?
Yes, yes, we do have your message.
Yeah. So,
Okay, so wish
I
to
have-
know that amongst the SIPs that are currently running, and I see that there are in total 13 SIPs
Yeah.
that are running, amongst them, which one you should take your money or rather make some
No,
more
no.
investment?
I don't want to take out the money.
Okay.
I want to know whether all these funds are okay for continuing the SIP, for anything to be changed.
Okay. Okay.
Yeah.
Okay. Feroz, it's a long list. If I get to read this, then you can see on your screen that SIP Blue Chip, SBI Mid Cap, SBI Small Cap, Canara Robeco, Canara Small Cap, Axis Mid Cap, HDFC Balance Advantage, Kotak Emerging, Kotak Banking Financial, Mirai, Tata Small Cap, ICICI Technologies and ICICI Innovation Fund. In total, Advocate Walson is doing 37,500 rupees of SIP per month. What is your understanding in amongst these 13 SIPs that he has shared, which amongst you feel that that's the best, and what are your views on the same?
Mr. Walson, first thing is you have to get your principles right. There are some foundation principles which mathematically have got established. If you can look at that data and come to the same conclusion, which you will, I would like to try to tell you the output rather than the input of it. I wouldn't buy myself a sector fund. On a risk-adjusted basis, you will make lesser money on a long term as an investor. That's point one. I would not buy an NFO. You've bought two NFOs which have not finished a year. If there are about 380 active funds in the market, like Shrishti mentioned, there are plethora of funds. What's my reason to buy a new one which does not have any history or track record or the portfolio construct today? So don't buy an NFO. That's the second piece of advice I would give you. And there's enough data to substantiate my claim that this is detrimental from a risk-adjusted basis. The third thing which I wouldn't buy for myself is a balanced fund because I would want to keep asset allocation at investor level. You're not a person who has only 1,000 rupee SIP. If you have only 1,000 rupee SIP, you might buy a balanced fund to get the flavor of these two assets. You're doing 37,000 rupee SIP. So you please have to do the asset allocation at your end rather than at the fund level. These are three pieces of foundation advice I'm giving to you and to a listener if you wish to consider these inputs, which I've learned over a couple of decades of data crunching. That's point one. Now coming to the specific list of schemes which you've sent across to us, I would request you to consider exiting about 7 of them. HDFC Balanced Advantage, ICICI Innovation Fund is not finished a year, so you make sure that you're not paying exit loads and wait on for a while. ICICI Approved Technology Fund, Kotak Banking and Financial Services, Axis Mid Cap, Tata Small Cap, SBI, Magnum Mid Cap. These are the funds you can consider exiting. The funds you can add to your portfolio are SBI Contra, ICICI Dividend Yield, HDFC Flexi Cap, and Quant Active. These are the 4 funds you can consider investing. That will bring your total to 10 schemes. I don't think 10 schemes are too many for a portfolio with 50 lakhs of current value and 37,000 of SIP.
Okay, so that's the advice coming in for Advocate Walson. But moving on to our next caller, and online we have Mr. J. Simba Sivarao. Very good evening. Please go on and ask your question to Feroz.
Yeah, so what is the performance of the Kotak Growth Innovation Fund, Global Innovation Fund?
Okay. We believe that you already have invested in this, Mr. Rao?
Yeah. So I want to know whether I should exit or add some more. I am a long-term investor.
Okay, 25,000 units at the rate of 9, right?
Yeah.
Okay. Feroz, he wants to know the outlook on Kotak Global Innovation Fund. He has already invested in 25,000 units at the rate of 9. He wished to stay invested for the next 3 to 5 years. And like he was mentioning, he's a long-term investor. So what's your view on this?
Mr. Rao, I think the first point is if this is the sole fund in your portfolio, then the recommendation or a piece of advice would be different. If this is a constituent of an overall big portfolio, the first thing you have to check is whether this is more than 10% of your money. If it's more than 10% of your money, you don't have to wait. You should surgically make a change. If it's less than 10%, you can hold on because there's other 90% deployed in the fastest growing economy, large economy, which is India. So if you're sitting in India, we are fortunate because the next 10 years, we will be the fastest growing economy, which we currently are as well. So depends on how much more money apart from this is there in your portfolio. That's point one. Point two, I can tell you some list of funds which you can consider adding. I don't have any global fund and I don't think my portfolio has suffered. If I measure risk, I don't think the risks are anywhere different because if you're going to have NASDAQ in it, which is what Kotak Global Innovation Fund has technology stocks as well as the name innovation goes. If you're going outside the country to invest, to reduce risk and then buying technology-based funds itself increases risk. So it's counterintuitive. So fundamentally not right. So if it's less than 10%, hang on. If it's more than 10%, exit. Don't wait here for 3-5 years. I think 3-5 years, a better prospect would be India and also the alpha in India. US does not generate extra return. Fund managers are now finding it very difficult to generate the extra return. But in India, you are able to generate 3-4% more than Nifty if you chose the right funds from the plethora of the ones which are available. I'll read out some funds which you can consider. They're flashing on your screen as well. ICICI Dividend Yield, ICICI Focused, Invesco India Small Cap. These are contemporary funds which you can consider adding into your portfolio. And a few others are also flashing. DSP Equity Opportunities, Franklin India Blue Chip, and HDFC Small Cap. This is more futuristically evaluated, trying to see if they can do better than their past performance as well.
Okay, so that's the advice coming in for Mr. Rao. But moving on, the next query is an email query, Feroz, and this question is from Mukesh Kapoor. He says that he's invested in Axis Midcap, Bank of India, Small Cap, and ICICI Pru Equity and Debt Fund, and he's currently investing 5,000 rupees each in each of these three funds. How will these funds perform for the next 3 years, and how should he look at and plan his investments? What's your view on this?
Srishti, again, I have to give a fundamental suggestion to Mr. Mukesh, which is to have the basics first, which is the large cap fund or a flexi cap fund are missing in his portfolio. So starting out with a mid cap, small cap and an aggressive hybrid, you've missed out the foundation stones, which is a flexi cap or multi cap, which has exposures to large cap largely, a flexi cap especially. Have a large cap or a flexi cap fund, add it to your portfolio, then having a mid cap fund, that's step 2. And step 3 is to add a small cap fund. So that's one is missing. So I think the two funds are good. Axis Midcap and Bank of India small cap fund you can hold. Axis Midcap has not done too well, but I think the damage is done. So quitting now would be like quitting at the trough. So stay on. ICICI Pru Equity and Debt Fund, which is an aggressive hybrid fund, can be exited. And some of the schemes which we told the previous caller as well, which you can see, can be used in your portfolio. But especially the HDFC Flexi Cap will bring in some degree of differential exposure to the current constituents of your portfolio, Mr. Mukesh.
Okay, so those are the advice coming in for our last viewer, that is Mr. Mukesh Kapoor. But moving on, in the next query that we have, Feroz, is also an email query coming in from Reddy Vijay Kumar, and he wants some suggestion on best mutual funds for a 20-year SIP. He wants to keep investing till 2040, and he's currently investing in the following mutual funds. Names are Axis Long-Term Fund on the equity side, DSP Tax Saver Fund, as well as Mirai Asset Tax Saver. So these three schemes is where he is investing right now. But other than that, any fund recommendations where he can stay invested for the next 20 years?
Yes, so I think he has all three ELSS schemes. Again, a fundamental suggestion. If you have already exhausted your Section 80C limit, which has been static from 2014, you may not want to get into a lock-in fund, which is what ELSS is. So just evaluate your voluntary contribution. Involuntary contributions in the form of EPF itself might be eating away the 1.5 lakh limit, which has not been upward revised for the last 8-9 years. So check that. If you're already used it, then don't use ELSS. Stop your SIPs in the ELSS and buy open-ended schemes, which will do better, and you will have the flexibility to take a U-turn. So I don't know about a 20-year scheme. Mutual funds are cyclical. So the extent of review needed is at least every 2-3 years to see whether the scheme is still contemporary and relevant. But as of now, I think the schemes which you can consider are DSP Equity Opportunities, Franklin India Blue Chip, HDFC Flexi Cap and HDFC Small Cap, ICICI Approved Dividend Yield, Kotak Emerging, Kotak Multicap, SBI Contra. These are the schemes you can consider which have a reasonable risk-adjusted potential over the next couple of years. But please try and not hold the same scheme for 20 years. You have to look at your scheme review has to be 2-3 years at least, because all funds are cyclical in nature.
Okay, so that's the advice coming in for Mr. Reddy. But with this, we'll let you go on that, Feroz. Thank you so much for all your time to ET Now and joining with us, not with a very interesting topic on the FPI's inflows and the market correlation. Other than that, helping all our viewers with their portfolio-related queries.
Thank you, Srishti.
Okay, but with this, viewers, it's time to wrap this edition of the Money Show. But before we go, a quick reminder to all our viewers that every day we throw the open stage to get your portfolio queries answered by the top experts, and on your screen you can see how easy the process is. You can connect with us on a WhatsApp number, that is 865-797-4571, or you can also email your queries on the Money Show @etnow.tv. What you can do is also mention your phone number so that whenever we are live onto the show, we'll connect directly onto the phone line and help you get direct answers from the top experts of the Indian mutual fund industry. Okay, but